you saying to me, okay, you're not going to increase the fee for me, but you've increased the fee for my employer. What do you think my employer is going to do to me? My employer is going to say, well, I've got an extra bill, so I'm not going to give you that pay rise I was going to give you.
Tax threshold. What is the impact of the government freezing it again this year?
Them not increasing the allowance is also like a way of still taxing you, because really they should have moved up, let's say, for example, to 15,000. So now we would have an extra 2,000-3,000 that isn't being taxed. So it's actually worse for everyday people. Anyone who relies entirely on one income stream is always going to be at the risk of that one income stream. One of the things that I've been talking about is the need to diversify outside of the UK. Whether you are planning to stay in the UK but still trying to build wealth, you can still build your wealth outside of the UK.
What are the key actions that employees and employed individuals need to take before and after the 6th of April 2025? What are your top tips for minimizing taxes in the 25 to 26 tax year?
You're not defined by where you come from.
Yeah.
And I think that's a big message that I always want to tell people.
Like, you have to be able to be uncomfortable.
Yeah.
Like, be comfortable with being uncomfortable.
When you grow up in ends, you don't realize it when you're confident, but you have an audacity to do things that ordinarily most people wouldn't be willing to do.
Welcome back to another episode of the podcast. I'm your host, Atto. We have a special guest in the building, a repeat guest. You'll probably know if you've watched one of our most popular episodes. So we have Benedicta, who's a CIMA Qualified Accountant, over 13 years experience working in government finance. She's a finance management consultant and public speaker. Benedicta, how are you doing? It's been a while, man. It's been a while.
I'm happy to be here.
Yeah.
It's been a while, but we've been connected.
Exactly. Yeah, I was going to say that offline we've been connected, people. It's not that we didn't just start speaking again today. Yeah. We've been speaking. So yeah, how have you been? Obviously since obviously I know, but since we spoke a year ago.
Yeah, it's been really good. Like, a lot of people reached out to me. I was saying afterwards, like, when everything went crazy, I was saying to my husband, I was like, everything I said in that podcast, I've been saying. Like, it's not like I just learned everything that day and said it, but I guess it was a right time. And so, yeah, a lot of people have reached out. A lot of people have been awakened to what's going on and wanting to do more, to change things potentially with their finances, which has been good. Off the back of the podcast, I had a webinar on More Money, Less Tax.
Yes, I think I remember that. Yeah,
again, it was quite good. We had I think 800 people signed up.
That's crazy.
Yeah, it was crazy. 800 people signed up. Lots of people, just, I guess, the opportunity to educate more people is what has really happened since that. So that's been really good. Like I say, more people are interested. I feel like in the past, sometimes we might have been talking about these finance things, but people really don't care. They've just been living in their own world. But I think last year it got to a point where people were like, you know what? I need to sit up and listen. What is going on? And so, yeah, the podcast came at the right time for them.
Yeah. It's so interesting because the timing, I don't know what happened, last year and why so many more people were more interested. I don't know if maybe difficulties in UK for some people.
Cost of living. Really,
you say, we've been talking about this for a few years. So I'm happy that it connected and, people kind of, I think you're one of those people that you're really trying, you've given us so much value. So the amount of value that you've given, I'm just really happy with it. I forgot to also say, right, you were recently featured in BBC as well for self-assessment tax knowledge. That's amazing. How did that go?
Very amazing. Tell my mama I made it.
Can you imagine, right? Because you're talking about the tax system and people were thinking, how do you go to BBC, right? And you got to the BBC.
They reached out to me, no hustling. No hustling.
Sometimes that's what happens, right? Sometimes I think you have to go against the grain and not always be scared and think, oh, I'm going to be blacklisted or this is going to happen, because opportunities will still come regardless, right?
We're not talking against anyone. Everything I say is facts, based on what the system is, right? And so, that was a good moment too. That was a good moment.
yeah. I'm looking forward to watching it. I haven't checked it out myself.
It wasn't BBC.
It was a video, but it was
it was an article.
Okay.
Which they literally, so the self-assessment deadline is 31st.
Yeah.
Literally first thing in the morning on the 30th, I think it was. In fact, people messaged me. So when you get that, that if you got the BBC app, there's a sound it makes, right? literally people started messaging me from before I even knew it was available. People started messaging me, oh my God, I just seen your name in this article. And it wasn't just, I think the good thing as well that I liked, that it wasn't just Benedicta, it was Benedicta of Beniratio Finances. So there's an acknowledgement of this business that we have been trying to grow, and we've been growing for the last couple of years.
I love that. I love to hear that. Okay, so obviously I introduced a little bit about you. Who would you say Benedicta is?
So Benedicta is your favorite accountant. I emphasize the word favorite, right? Nobody really likes talking to accountants. You think about accountants, so you think tax, you think they're going to take my money. You also think someone boring, old. So for me, I'm really just trying to make accountancy relatable, simple. Yes, simple. No debits and credits here, no funny terminology, right? Is it money in or is it money out? So just making it relatable, educating the people. And I think I was saying before that, you know, there are many people out there who talk about finance online who don't necessarily have the qualifications. And I'm not knocking them at all, because a lot of them have years of experience and they've literally, you know, turned their lives around. But I think for me, my key thing is having the knowledge from the accounting. Like, I went to school for this. I've trained for this. I make sure I'm up to date on tax laws and stuff like that. And then I also do it. So I have customers that I'm doing. So for me, it's taking all of that knowledge and, you know, bringing it to the education space. So yeah, more than just accounting is another phrase I always say. It's not just tax return and that's it, but actually, what else can we do? So the education piece, making sure that people understand it, showing people the potential, I don't want to say loopholes, but things you can do legally to be on the right side. We always keep it legal. To be on the right side of the law, how you can adjust your finances. So that's what makes me your favorite accountant.
Yeah, amazing. And you know what? I love the fact that you say that you're bringing in what you've learned from, you know, studying accounting, because I think sometimes people are not able to connect that. You know, connect what you learn to the everyday person. That's what you want to do. That's that bridge.
I'll be honest, right? The way they teach you your professional accounting is to work in a company. I'll be 100% honest. However, from there, there's another level. And so for me, connecting like with mentors and self-educating, and then doing the necessary requirements. So for example, for anyone who cares, any accountant that's listening, maybe a student, when you first become qualified as an accountant, that's one level. If you want to be an accountant that does tax returns, you have to do a whole nother certificate. So I have 2 certificates. I have my certificate that allows me to be an employee accountant. And then I had to do more training. I had to do more practical experience. So I had to get someone else who had their own accounting company to sign me off, to teach me, to show. And then I had to self-teach, self-learn as well, like the HMRC portal, companies, how all of that works. Put that all together in another CV, and then you apply. So it's not automatic. Even though you're already an accountant as an employee, you apply, show them that you've done all the necessary things, and then they give you something which is like basically they call it members in practice. So that allows you to be a practicing accountant. That allows me to go on my own and do accounts for people with no like supervision.
Wow. Okay, so there's definitely levels to it. Levels. And look, you've gone up the levels. You've gone up the levels. So you obviously you mentioned before, right? Like, you know, tax changes and updates. So today we want to talk about some of those changes, especially as it's coming to, you know, the end of the tax year and beginning of the new year. I think it's going to be very, you know, interesting for people to know. So I want to start with the personal tax. So how we'll kind of break it down for people in the podcast to make it a bit easier as well for people to go through this. So we've got the personal tax side and then the business tax side, right? So starting off with the personal tax side, right? Tax threshold. My understanding is it's staying the same. So it's going to be staying frozen, right?
Till 2027.
Right. So currently the personal allowance threshold will remain at 12,570. I feel like I read that number for the same number for the same years, right? So I guess, what is the impact of the government freezing it again this year?
Yeah, so we all know about this wonderful thing called inflation, whereby prices are constantly rising. And if you're living in the UK, in fact, if you're living anywhere in the world, you know that prices have gone up. And so if you, like you said, you've read that number for how many years? I do remember a time when it was 11,500 though.
That's true. I do remember that. Yeah, I do remember that too. Yeah.
From 11,500, it went up to 12,570, but it has been like that for at least 5 years, I believe. And so you can imagine, right? 5 years ago, bread, I don't know, let's say bread was £1 5 years ago. Now you can't get a loaf of bread for £5 for £1. A loaf of bread might be, I don't know, £1.30, for example. So the prices have gone up. Ideally, the personal allowance should have also gone up, right? Because your 12,570 would have been able to buy you, for example, 12,570 loaves of bread, right? But now, because the price has gone up, you can't buy 12,570 loaves of bread. You can only buy 12,000, for example. And so ideally, the price should have gone up in line with how the prices of goods and services are going up.
Yeah.
But it hasn't. So what it actually means is that them not increasing the allowance is also like a way of still taxing you.
Yeah.
Because really, they should have moved up, let's say, for example, to 15,000. So now we would have an extra, 2,000-3,000 that isn't being taxed. But what they're doing is that extra 2,000-3,000 is now still being taxed at the basic rate. So it's actually worse for everyday people.
Yeah. Which is crazy, right? Because I was reading, right, like, I'm going to say this. I'm saying it. My pay rise this year was not more than inflation. Okay. Again, correct me if I'm wrong, right? I know inflation is slightly above 2%. It's not at the 2% target right now, right? So my pay rise is around inflation. So it technically means I didn't get a pay rise.
Yeah, that's what it means, basically. So you are basically in the same position. But do you know what's actually worse? So your company, clearly you work for a good company, a responsible company, because you best believe there are some companies out there that ain't changing nothing.
Exactly.
They will keep you on that same salary for as long.
1% rise, 0.5%
They won't even
rise.
give the 1%.
Yeah.
I've been at companies that I didn't stay there long. Anyways, but let's say your company is a good company. They recognize that, prices are increasing. Let's at least give our employees 2%, 3%, whatever they decide. But the effect of that 12,570 personal tax-free allowance staying the same, not only does it mean you got a pay rise, but inflation was even higher than the pay rise already. But also that 12,570 stayed the same. So all of that pay rise is being taxed. Yeah. If that makes sense.
Yeah, exactly.
So you're basically being hit on both sides. Number one, the pay rise wasn't higher than inflation. Number two, the personal allowance didn't change. So you're paying more tax.
Yeah.
Not you, everybody.
Yeah, everybody is. And that's the thing about it, right? And even inflation, I've got questions about that. We're gonna talk about that in another episode. Because the percentage increases that I'm seeing personally on things, and it's not 2% or 3%.
Inflation might be 3%, but then the price is going up by 4%. Hey, what happened to? I think wasn't it just last week or which week in March when the rail fares went up by 4% or something? Exactly. But inflation is technically, they say
exactly. What's real life inflation? not the government numbers that they try. Oh, we're trying to get into. What's the real life? How much am I paying to eat? How much am I paying to travel? How much am I paying in terms of my mortgage? My mortgage inflation, if you want to say that, was not
interest
2%.
Yeah.
Increase.
And that's the thing, right?
Increase.
Yeah. I heard one of my friends, her mortgage went up by £800. Because she was when she got her mortgage, it was on a really low fixed term. And then obviously everything went crazy. £800 per month.
Do you know how wild that is?
Thank God she has a decent job so she can afford it. But that's like, imagine you got that and you got like 2 children, 3 children, paying for childcare and that's the thing. It's not just one thing that goes up. It's all of the items. Yeah. So the childcare, the food, the petrol, the energy prices, the train ticket, everything.
It's crazy. Okay, so picture this. You just delivered outstanding results for a client and they ask you to provide your services or products for free. You say no, right? And for good reason. Your time, skills, and effort are valuable. But when you leave your business funds sitting in a regular current account, you're essentially doing the same thing, missing out on potential earnings that could help cover essential business expenses like taxes, staff wages, software subscriptions, and unexpected costs. That's exactly why I use Ties Instant Savings Account, where I passively earn 3.81% AER Variable on my business savings without doing any extra work. Plus, I can access my funds instantly anytime I need them with no withdrawal fees. And I get FSCS protection on up to £85,000. My savings stay secure while they grow. We're teaming up with Tide for this episode and they've got an exclusive offer for new members. Sign up with my code SAVVYWALLET and get a £100 bonus when you open and fund a Tide Instant Savings account with £5,000 within the first 30 days. Opening a Tide Instant Savings account is quick and easy. It takes just 4 simple steps. To claim your £100 bonus, tap the link in the episode description and enter the code SAVVYWALLET when signing up. Boosted offer valid until the 1st of June 2025 for new customers only. Rate correct as of the 6th of February 2025. Visit tide.co/savings for up-to-date rates and full terms during and after the promotion. In terms of, we did speak about this again on the first episode, so make sure to go and check out the episode that I did with Benedicta about a year ago. Are there any legal ways for a person to reduce their taxable income to offset like this, obviously, the impact of the frozen threshold?
Yeah, so I wouldn't say necessarily to offset the frozen threshold. I would say that in terms of additional income that you can make. So one of the things that everyone talks about, side hustles, making more money, right? At the end of the day, if everything's going up, you need more money, right? And so it's just about being savvy with how you make that money. So using things like a limited company to put that extra money in. I'm not going to rat out my customers, but some of them have 9-to-5s and a contract role. Some of them have 2 roles at the same time or 3 roles. But what you do is you have your 9-to-5 in your normal PAYE, and then you might have a contract role that's being paid through your limited company. And so by doing that, you're keeping more of the money, less of it is being taxed basically at the, the 20%, 40%, 45%, because it's in a limited company, which has tax of 19% with profits below 50,000.
Yeah. And that's the thing, right? It's like, I like the fact that you said limited company, because there are advantages to having business, and we'll talk a little bit about that later. I do agree with, I think more people need to get into the whole fact of side hustles. They can kind of stay as side hustles. I think it's okay. There's a world where you can make a bit of income on the side and you're consistently, I don't know, it's 1,000, 1,500, and you're happy and you don't want it to grow anymore. And it's maybe, let's say it's a straightforward side hustle for you. There's a world that's going to be nice for you. An extra, if anybody could get extra 1,000, 1,500, that's nice for you, definitely. Right? That could be a big difference. That's the difference between you, I don't know, saving deposit for, an investment property or investing in the stock market. An extra 15 grand in the stock market every year is a lot of money compounded. So I think that's quite important. So the national insurance employee threshold is also staying the same. I guess what impact will that?
So one of the things that Labour said when they were coming in was that, they're going to tax the rich. They're not going to, they're going to be for everyday people. And so this whole thing of, not increasing NI, because to be fair, in the past, we may have noticed that the percentages had gone up. So whereby you'd pay, apart from your normal 20% tax, your NI contributions also would go up by 1% or 2%. And so they said that they wouldn't change that, which again, fair enough, they didn't increase it, it's okay, but they still didn't give allowance for the fact that inflation. But anyway, we've already talked about that. But what they did do on the flip side was that they then went to the owners of the companies who pay the employees and increase their tax. So you saying to me, okay, you're not going to increase the fee for me, but you've increased the fee for my employer, what do you think my employer is going to do to me? My employer is going to say, well, I've got an extra bill, so I'm not going to give you that pay rise I was going to give you. Do you get what I mean? It's just a different way of doing the same thing, in my opinion. And, for companies that, especially that have thousands of employees, hundreds of employees, not having because what it was is that employers, so business owners now, not employees, their NI contribution went up from, I believe, 13% to about 15%. And that, it sounds like, it's just 1%, it's just 2%. But imagine that across 1,000 employees, like their wage bill has just increased dramatically. And that's money that they're having to pay to HMRC that they could have given to you in bonuses, they could have given to you in salary increases.
Yeah. And we're going to talk about that. And I think that in terms of percent increase, if I'm just looking at my notes, so it was 13.8% to 15%. Yeah. And that's gonna come into effect from 6th of April. So it's gonna be interesting. And we're gonna talk a little bit about this and what you think are the potential impacts. But before that, I want to talk about other personal stuff. Council tax. I think I've got my council tax bill. I can't remember it off the top of my head. I should have really looked at this before. But what I do know is that apparently they're going to be able to raise this by up to 5%, right, in England and Wales. And just to say, sorry, let me ask this. Everything we're saying is just applicable to England, right?
Yeah, of course.
We should just say, because before people come on to me, right? So everything that we're talking about on the podcast in terms of like tax changes and changes is applicable to England. So just sorry, no disrespect to Scotland, Really appreciate my Scotland listeners, but for today it's gonna be England changes. So as I mentioned, right, local authorities are going to be able to increase it by 5%. How do you feel about this change, and what do you think its potential impact will be on households across the country?
So on a personal level, I don't ever remember my council tax bill ever not increasing. Personally, I don't think there's been a year where it's been like, oh, keeping it the same. Never. It's always higher. So I'm not really shocked by that. Maybe the percentages, maybe there's an allowance. I guess maybe potentially, I don't know. I'm not a council tax expert, but just from a economy and a finance point of view, I know that maybe the percentage increase might be higher this time around. And so definitely it's another thing that is increasing, right? You've got your what's it called? Your train and bus fare, you've got your petrol, you've got your heating, gas and electricity, energy prices went up, and council tax is just basically another bill, another compounding bill. The challenge though with council tax compared with some of those other things is like, let's be honest, right? Okay, maybe you can do a few things here and there, work from home a bit more so you don't have to take the train, for example, keep your heating down a bit more, wear more layers. You literally can't do anything about your council tax.
That's true.
And the way those people hound you down, I mean, you might owe £1. They're taking you to court, £80 on top of the one. Yeah. I've had some threatening letters.
Wow.
Not because I don't pay, but I think especially in between houses, let's say you've moved to one place and, the timing and all of that didn't quite match up or whatever. You see the way they write these letters. I was on Martin Lewis, shout out Martin Lewis. I was on his page the other day and he did a similar post talking about council tax and how aggressive the people can be and actually how he's petitioning. How he's petitioning to kind of get them to ease up. Like, calm down.
That's crazy.
One of our properties again was in between tenants. So we had about a month where there was nobody in the property, a month to 6 weeks. And I received a bill. I said, my property was empty. What are you council taxing me for? And because before, when we first bought the property, there was definitely a time where you could have exemptions for if you've got an empty property, you don't have to pay council tax. And so this is last year now. And the lady says to me, it's for the police and the bin services and this. I said, but there was nobody in the house. We don't need police. There was no bin. There was nothing. What are you She said, well, that's their policy, that they don't do empty house discounts, so you have to pay. I had to pay council tax for an empty house on top of my own personal council tax that I live in.
Yeah,
this is the world we're in.
The council tax is mad.
Obviously, there are a few things here and there, but it doesn't really apply. If I'm honest, some of the things I'm going to say it doesn't apply to many of your listeners. But for example, if you're a student, you can actually get, if everyone in the house is a student, you can get complete exemption. If you're in the house as a single occupant, so no two working adults, you can get a 25% discount.
Yeah.
So that is a good one for single parents, I guess, out there. But again, most average families that may have two, even if it's not husband and wife, but even if it's like a parent and an adult child that's working, you're technically not eligible for that discount. And so you're going to have to pay that bill.
That's the thing. Sorry, people, you're going to have to pay that bill. Yeah, I was out when I was living by myself before I got married, I was doing the single person discount. Any discount I could get, I was getting it. I'm not even going to lie. I was doing that. That 25% was nice.
Yeah. That's actually, to be fair, that's actually quite a liberal discount. But for me, I don't know. I just feel like in the UK, they look for any reason to tax you. Next, they'll be taxing the air that we breathe.
I mean, talking about
you've been taking too many walks. You're wearing down our pavement.
I will not be surprised. So let's move on to capital gains tax, right? Yeah. Because there's been a change there, right? So in the autumn budget, the government announced an increase in capital gains tax effective from the 30th of October 2024. So it was immediate, right? But although the residential property rates are, capital gains tax is staying the same. Can you kind of summarize what those changes were so people understand and what scenarios it kind of applies?
Yeah, so basically previously, if you sold an asset, you basically have made capital gains on that, and that includes you crypto people. Because it's a form of asset, right? Yeah. So if you made a gain on that, you would pay depending on your total income. If your total income falls in the basic rate tax bracket, then you would have pay 10% on your gains. Don't get me wrong. There is a capital gains allowance, which used to be 6,000, went down to 3,000. So that's almost like the tax-free version, like how you have your 12,570 for salary. It used to be 6,000, 3,000. So yeah, normally you would pay 10% on any profit, any gains that you made. That has now, that's if you're in the basic rate. And if you were a high rate taxpayer, so let's say your total salary was above 50,270, but lower than 125K, then you would have paid 18% as tax. Now, those numbers have changed. The 10% has now become 18%. That is literally an 80%
almost double,
increase. Yeah, almost double. And then on the 20%, that rather than it being 20, that's now gone up to 24%. So what that basically means is especially landlords with second homes, not your primary home, landlords. The reason why I mention landlords, because obviously houses cost more money, right? But it applies to if you've got gold, if you've got pit frames, wine, whatever kind of assets you're into. You're basically going to be subject to those rates. So it does mean that, I guess, for some people who might have been thinking about selling, I think that it's going to make people hold on to their properties longer.
It makes sense, yeah. Until
I'll
it goes
just
down,
milk that cow.
Yeah.
Either until it goes down, or I'm just going to use the cash flow that comes in. I can, for people who know how to do this, you can leverage, if the property price is increasing, you can leverage the debt on that property and use that to do other things. So I feel like there's no incentive to sell as much, in my humble opinion.
Yeah. So you think the impact is that it's probably making people hold on to assets longer than they may have?
100, especially for high rate taxpayers who are likely to be the people that have second and third and fourth or whatever properties. Why am I going to sell my house and then be subject to 24% tax? I'll rather take out a loan on that. I'm going to milk this. I'm going to take out a loan on that. I'm going to buy more assets. And then at the time when maybe I'm no longer a high rate taxpayer, maybe in like retirement or whatever, you can do crazy things, with your trusts and stuff like that. Put it in a limited company. You hand it over to your children via a limited company, via a trust, or via a holding company. These are different ways that you can still build wealth and pass it on without you having to incur income tax. I think the challenge, because what people need to realize is that fee is only triggered once the sale goes through, once a sale goes through. You holding that asset doesn't make you liable to pay anything. But yeah.
Okay. That's so interesting.
Funniest thing is, for the high rate taxpayer, the difference is not that much. So the going up on the lower bracket is 80% more than you would have paid before. But on the higher bracket, it's only 20%. 4,000 over 20,000 is 20%. So difference between 20 and 24 is not as much as the difference between 10 and 18, basically.
That's crazy. And wow, that's huge changes.
One of the ways, again, that people try to get away with that is the limited company, right? Because the capital gains tax is triggered when the money comes to you as income. If it's in the company, the entire amount goes into the company. You can reinvest that money, or you can draw it down in bits. Okay. According to your allowance.
Interesting. Yeah. Can you explain that a little bit more? I'm quite interested to hear about that. Yeah, can you explain that? So capital gains, it's like income tax, right? Yeah.
Yes, the rates are 20%, 40%, but if you don't have no income, there's nothing to charge it against. Okay. If I have not declared, or I've not taken that capital gains into my name to say, hi, I'm Benedicta, I've just sold my property, here is the profit that I've made, I want to go use this profit to go on holiday. If that money is in a company, technically Benedicta hasn't made no profit yet. Benedicta's company has made profit, so you will pay 19% on gains there. Right. But Benedicta, the whole thing about your personal allowance, that does not apply.
Okay, I get it. It. So if you buy and maybe we have to do another episode about this, because I don't want to get too crazy, because we got to go to other questions. But basically, a general idea is, when you buy a property through a company, it's subjected to like the corporation tax stuff and whatnot, which is a bit lower tax.
A bit lower. Yeah. But when you then take the money out of the company, that is when you are now declaring income in your name.
Yeah.
And then you will now be subject to the personal tax rates or of income tax or capital gains.
Okay,
Yeah.
interesting. Okay, we're gonna have to definitely do one on that because I think that's gonna be like very, very kind of interesting. And do you know anybody who's been impacted by these like capital gains?
So not necessarily by capital gains, not anyone that I know personally. At the time when the announcement was made back in October, I was speaking to one or two, I was speaking to a property lawyer and I was speaking to a broker, and both of them had active clients that they tried to just turn things around for. Like their phones were buzzing, like people were trying to get their sales through immediately. So I don't know anyone. Obviously I'm not a broker, I don't sell properties, but what I do know in terms of, or what I have seen in terms of friends and family, is people who were thinking about buying property, who are just taking their time and all of that because of the stamp duty changes now. So stamp duty, land tax, different from capital gains, which the changes coming up in April, trying to secure properties. And actually one family I know has actually done that, secured their property that they want to buy before the stamp duty changes come in, because basically the stamp duty changes are going to make it more expensive to buy a property.
Yeah. That's the thing about a lot of these kind of changes, right? Like people are going to often be scrambling. And with the, what I did like about the capital gains one, it was almost immediate. So there's like almost nothing you could do. And I think they were quite smart in that they knew that like,
and it was on a random weekday. Like people that work, no one's even
exactly. What are you going to really do about that on the same day? It's effective already, so there's nothing you can kind of do. It's not like with April where you've got a bit of time, which is a bit of a shame.
That's what they did also with right to buy, by the way. we can't let go of this right to buy thing.
Yeah. The right to buy one's crazy.
The rates in the drop crazy, but not just that. It was also implemented. I think the deadline was like 1st of December or something, or end of November. So it was literally like I think 2 or 3 weeks. For people to basically make the most.
Yeah. So what do you feel has been like the implication for like business owners? You know, maybe they've been contemplating selling property, maybe any kind of assets they kind of have, even like personally as well, for people who you know.
So with the capital gains, like you said, because it came into effect immediately, people who would have been sitting on the fence would have been thinking about, okay, we need to sell quickly. So for business owners and stuff. But the truth is as well, the time is still short. Even if the deadline was to change in April, if you're going to sell a business, sometimes there are things you need to put in order. Beforehand. True. And then even if your business is in order, businesses is not like bread. I don't know why I'm talking about bread so much, bread or tomatoes, whatever. Like you need to find someone who wants the business. Do you get what I mean? I know someone who's been trying to sell their house for like over a year because their house is massive. Their house is not necessarily like in a like high street or something like that. And so you need a specific kind of buyer. And so with businesses, you know, depending, who knows, maybe there might be people who might be ready. Maybe your business is in that kind of market, but not everyone has that kind of business. And so, you might have tried to do something, but ultimately, if you don't do it in time, literally, once the date changes, the new rate applies. Yeah.
And that's the thing. It's a bit crazy because this kind of, like we said, it doesn't just impact property. If you haven't managed to, you know, have your stocks and, you know, shares in like a stocks and shares ISA, it might impact you there. Then, like you mentioned, crypto as well, which is a bit of a shame. I wish there was like a tax-free way to kind of leverage crypto. So obviously we talked a bit about capital gains, right? What strategies can individuals use to reduce or offset their capital gains tax bill?
In terms of capital gains, one thing I would say, maybe, I don't know if this is necessarily the direct solution, because the truth is, so we've already talked about potentially buying properties in an asset, right? Or via, not in an asset. We've already talked about buying properties via a limited company. But one of the things I'd also say, which is not really as widely talked about, I think many people talk about the limited company thing, is actually looking to invest overseas. I know this sounds cheeky, but one of the things that I've been talking about this 2025 and I've added to all my discussions is the need to diversify outside of the UK, because first of all, the UK is not the be all and end all of life. First of all, don't get me wrong. We have many good things, and I'll be the first to say that the UK is a very strong economy. We've got good money and all of that. But you may or may not know, many people are leaving the UK.
Yep, of course. Talked about it on the podcast loads of times.
Exactly.
Yeah.
So actually, and I was saying this earlier, like whether you are planning to stay in the UK but still trying to build wealth, you can still build your wealth outside of the UK. And if your asset is in another country that has lower tax rates, then you can pay the lower tax in that country, right? And as long as you're not bringing millions and millions of pounds into the UK, technically there's nothing to declare. And actually, what you can also do is even if you do make a lot of money out in another country, it's only the proportion that you bring into the UK that you necessarily have to pay tax on.
Yeah.
There's something called remittance, like deferred remittance. And so what you do is, yes, you acknowledge that, yes, I live in the UK. Yes, I've got assets in another country. However, I've only brought in £10,000, for example. And so you would pay tax on £10,000, even though you might have made £50,000. So you can actually build your money quicker, faster. I was watching another podcast the other day where the guy was saying, it's not like you can't make money in the UK. It's just that in other countries, you can probably do it faster. It will take you longer, more effort here. And so people should look to diversify. And then, and I say that, like I said, the solution isn't just everybody move and leave. Even if you are going to be here, look to invest abroad in a more tax favorable environment. And that's part of diversification anyway. As they say, don't put all your eggs in one basket, right? Anything can happen to the UK economy tomorrow. And then likewise, on the flip side, if you are going to move away, which many people have, I'm sure you know people, I would say that you should still maintain some kind of roots here, just because the UK does have good returns, and also it's a stable economy. Like I say, you might be going to somewhere that is not as stable, might not have as much growth, depending on where in the world you're going to. And so I think it's good to have the great British pound in your back,
it's very
in your
good.
back pocket.
So, okay, you know what? I like the fact that you said not just focus on here. And there's going to be more conversations that I'm going to be doing about that subject. Okay, what examples of doing that? What examples can people kind of look to be able to, like, you know, be able to build their wealth outside of the UK?
Yeah, so there's a lot of, particularly around property, and particularly in the Middle East, in UAE, there's a lot of, I was literally at the tube station this afternoon, and I saw the big signboard, and I've known about it generally anyway, from friends and family and also from my own research. But again, just reiterating how easy it is and how much these people are looking for people to invest. There's a big billboard in the tube station. Invest in furnished property, so not just property, furnished property, £145,000, which is way cheaper than anything in the UK, an 8-year payment plan. And I did the maths on my calculator, because as an accountant, that's what you do. And it came out to like, what if you put a 10% deposit, it would be like 15 grand. It came out to like 1,300 per month. That's kind of what you would pay here, but you would be finished paying in 8 years. You would own the asset, and because people are flocking to those countries, all that cash flow would be free, basically. So those are some of the things. So there are many companies basically that are advertising, trying to actually target UK investors that have strong, they know you have money. They know your currency is good. They know it's not like Nigeria where if you come with Naira, you have to come with a big bag. Like, they know your currency is good. So they're targeting UK. They targeting, you know, people who are high earners in the UK. They know that you've got money. They know that you're wanting to invest, and you're probably wanting to do it in a tax efficient way.
Okay, so property is like one kind of avenue, but like looking at property in like different places.
Countries,
so like UAE, we know UAE is popular, you're right. And UAE is a smart one because we just know that a lot of the workforce is going there, and it's just going to keep on getting built. So in terms of, you know, having people that are like professionals looking for, like, you know, places to rent, there's going to be a load of people,
and it's not just people from the UK, it's people from all over the world. So there's people coming in there from Canada, there's people going there from Africa, there's people going there from other parts of Europe.
I really love that, man. That's a good idea. I've been thinking about that a bit more. Like, it's so
That's
it's so
my next
interesting.
move. I don't think I'm going to buy another property in the UK. Not because not because I can't, I think I'd prioritize buying abroad first. And then if we got loads more money, then maybe we think about it. But for me, I think that's the next best thing to do.
Yeah. Is there any other things that you've heard people do aside from property as well that you've seen?
Property is the big one just because of the numbers.
Yeah.
But a lot of people are also opening businesses in Africa.
Okay.
Yes. The reason why is because you may have heard, or you may have not heard, that there's speculation, depends what school of thought you belong to. This is definitely like, I know some people might slate me for this, but there's, in the whispers that there's going to be a famine, global food shortage. Have you not heard about there going to be a global food shortage? That we're
I might have an idea.
We're not
it,
producing. Yeah, it's not like
it's not official.
Yeah, it's not official. It's not like BBC News are going to announce it. But people who do like, predictions, they say that, a lot of the food that we eat, and that's, there's even campaigns like against food wastage, right? That for the number of years people are living, for the volume that people are eating, etc., the amount of food that's being produced is not equivalent.
Okay.
And so, quote unquote, there might not be, I don't know, be a global food shortage. So Africa in particular, agriculture, and not just agriculture because they have good economy. Is it economy? Not economy. Good environment.
Yeah.
So the climate is good for producing food, right?
Yeah.
Whether fruits or grains, rice, whatever. But also the fact that you can store it. So growing the kinds of food that can be stored for a long time and not have, not basically still be okay. So a lot, I know people that are going into that kind of stuff, but not just that as well. So that's agriculture. People also opening businesses to do with tech again in Africa. Why? Because they're a little bit behind, and not just Africa, but places like South America where they're not as advanced. Everything that we take for granted here is still on the up for them.
Yeah.
And so going to such economies and being able to invest almost, make it so that they want to become the West, right? I wouldn't say they want to become the West, but they want to get to the level of the West, right? So any kind of investment in tech, agriculture, that kind of business in the West, South America, is also lucrative.
Interesting. That's very, very, very interesting. I can understand that because I guess you can kind of see it like there's growth opportunities there,
the
right?
economy is still in its infancy, so it has opportunity to grow to like what the UK is. And by the way, I say that as well, even about like the UAEs of the world. You see how everyone's rushing there, low tax, low this, low that. In the UK, it wasn't always like this. This is built up. And so I believe that in Dubai, in Saudi Arabia, Qatar, all these places, they will eventually, because the volumes of people coming in, they will eventually have to start increasing their taxes here and there, little by little by little, until it gets to a certain level. Hopefully not the level of the UK.
That's so interesting. So another thing I wanted to kind of talk to you about, right, was, obviously we've talked about some of these tax changes. I guess, how can people use tax-free accounts like, cash ISA, stocks and shares ISAs, as well as like, tax efficient? I'm saying account here, but it's just so that, I can explain this right, like pensions to really like look at reducing their capital gains tax liability. Yeah.
So definitely number one, if you're going to invest in the UK from just a simple savings account kind of thing, and you're wanting to invest quite a lot as well, definitely be using your ISA. So everybody has the opportunity to save up to £20,000, and whatever profit is is made from that £20,000 is tax free. So that's highly encouraged. If you're thinking about buying a property, there's also the LISA, lifetime ISA, which you get 25%. Come on.
I know, it's a lot.
That is lucrative. The government, so for if you put in 1,000, they'll put in, if you put in 4,000, they'll put in 1,000 as an example, which is literally free money. But the only catch-22 there is that obviously you have to use the money in a LISA either to buy your first property that you're going to live in, no investments, nothing like that. So your first property that you're going to live in. Alternatively, you can open up a LISA. If you're going to save towards retirement, again, you can have it. And then when you reach the pension age, that's when you can access it. Don't get me wrong, you can access it before, but there will be penalties, i.e. you're not going to get the £1,000. And normally they would say, like, if there was a life event, for example, then you can heaven forbid, if somebody had cancer, someone died or something, right? Yeah, you need the money. So that's one way to invest, make profit without having to pay tax and avoid the capital gains tax. The other thing in terms of pensions, particularly for high rate taxpayers, and this is something that I've pushed a lot in the last 1 year, especially when you get to that 100K threshold, pension contributions are supposed to be tax free. So anything that means that you're paying into your pension outside of, from your bank account, you're making additional contributions. It didn't go through your pay slip, right? It means that you already paid tax on that money. And so therefore you're eligible to claim that money back. So one, you are able to invest extra into your pension, and the government will ensure that they meet up as well on the measurement, on the match. But also you can then do a self-assessment to claim back the tax that you already paid. And funny enough, I did a pensions webinar literally 3 days ago. Yeah, literally on Tuesday. And we were talking about this, and I used an example of one of my customers who put £25,000 into her pension, and I believe she got about 8 to 10K back.
Wow.
Yeah. Cash.
Amazing.
This is cash money that you can spend. This is not money that has to go away now. So yes, she put 25K away. You could argue, she could have used the 25K, but that would have been subject to a lot of income tax. But she put the whole thing away, no income tax. Also, she did it via a limited company. So therefore her limited company had no corporation tax.
Wow.
She basically cleared the whole profit because she had a 9 to 5. I have to disclaimer. She had a 9 to 5 and a company. Yes.
Okay, but she was using her business to
generate money,
and then so that she doesn't have to pay
corporation tax, she put the profit into pensions. And then we did a self-assessment for her, and she was able to get the tax relief.
And then that money back.
Yeah.
Ooh, there's so many levels to that. Wow, there's so many levels. That's a smart person.
Very smart. And it's not just her. I've got loads of customers that do it. I've got customers who don't even have businesses that have done this. So another one that people don't know about is charity. Obviously, a lot of people give to charity, especially if you have a church, right? If you're the kind of person that gives a lot to charity and you're a high rate taxpayer, again, charitable donations are supposed to be less tax. And so as a high rate taxpayer, you've been giving lots to your church or whatever charity that you prefer, we can do a self-assessment for you and you're likely to get money back.
Yeah.
One of my customers, she doesn't have any business. We just did a tax return for her because she was giving a lot to her church.
Wow.
And she got, I think, 14K back.
Wow.
Yeah.
Okay, people, you heard.
But you have to have the money in the first place. That's what people don't understand. The way the
Just
UK
don't get it.
the way the UK system is, you have to have put something in to get something out.
Yeah.
That's how it works. So don't come to me if you have your salary is 15K and you barely pay any tax and then you're asking for tax. There's nothing like that.
Yeah.
Right? It's for the people who are, above like the 50K mark as you start getting to 100K as well.
Okay, so start using some of these benefits to
to bring down,
Yeah, that's nice. I like that. Wow. We got some follow-up questions to definitely, we got some follow-up conversations to have, especially on the pensions and the limited with property. I think that's going to be very interesting. So, you mentioned before the NI on the employer side, right? So from the 6th of April, 2025, that's going to be changing, right? So employers will face an increase in national insurance contributions, and we mentioned it, right? So it's going to be, I think it's from 13.8 to 15%. So that's increasing from 6th of April, right? Which is going to be, I think by the time people listen to this will be in a few weeks, right? So I guess, what's the impact of, that kind of change, right? You kind of alluded to it earlier.
So the impact of that kind of change is that, in my opinion, employers will not have as much money to pass down to their employees. And so things like bonuses and bonuses and salary increases are likely to be less than they would have been without that increase, because obviously they now realize that they have another bill that needs to be paid, basically. So I feel that it will lead to potential stagnation in wages, which again, if your wages are not increasing in line with inflation, then really you're losing out. But again, having said that, I'm someone who likes to understand what's going on and then make a move rather than just understand what's going on and then say, oh, woe is me, and just sit there. The truth is, in this same economy, people are moving jobs like left, right and center. They're moving jobs and getting paid more. And so if you're in a place whereby, do you know what, you need extra money, you've been working, you're good at what you do, you're not just job hopping, but you've been in your place for a decent amount of time, I would encourage you to look around, like move to another job and negotiate the hell out of that offer.
Exactly. And that's the thing. I think the fact is once you hear these things, like you say, you make yourself informed and then you decide, okay, let me make a change. I'm not saying don't complain. You can complain. We can complain. That's okay. Complain, but
do something about it.
Exactly.
My last 3 in my 9 to 5 life world, my last 3 jobs, I've gotten nothing less than 15k increase every single time. One of them I got 20k.
That's crazy.
Yeah.
Wow.
I'm not, but I'm negotiating the hell out of it. And I'm making sure. And so for me, all this stuff about, my employer didn't increase my salary. It's just too bad. It has nothing to do with me because I'm getting 15k more.
Once they say that, you're out. You're out to the next literally. One. Yeah. So that's the thing, right?
Yeah. So, and obviously I'm saying this, you can't be rubbish at your job. You can't have no skills. Like you need to have skills. You need to, be employable basically, to be able to do that.
And that's the thing. You do have to be diligent. And I think, I get it. I understand that sometimes it's like, it feels like hustle culture. But I think at the end of the day, right, like we have to do it for ourselves. People will not do it for us. If we don't do it, unfortunately. Literally,
that word unfortunately is what they will be telling you when they need to make redundancies. Unfortunately, I know you've been here for 10 years, but unfortunately, we just can't afford to. So you better move before they move you.
Oh my God, it's true. That word unfortunately being everything. Unfortunately, we're going to take your car. Unfortunately, we're coming to lock your door or kick you out of the house or whatever.
No bonuses this year. Unfortunately, no pay salary, no pay increase. So you better sort yourself out.
Yeah, that's just the thing, man. Unfortunately, I'm saying it again. I'm sorry, people. I'm really sorry.
How do you know you're a Brit? I use the word unfortunately.
So on the other hand as well, the per employee threshold at which employers start paying national insurance will also be reduced from 9,100 to 5,000 per year, right? So in simple terms, what does this change mean for the employers?
Repeat that again. The per employee threshold
at which employers start paying national insurance will be reduced from 9,100 to 5,000 per year.
Yes, exactly. So again, basically they're squeezing them on both ends, literally. So you've got the national insurance contribution increasing, but normally you wouldn't have to pay that like you said until basically until the employee's salary is above a certain amount, and then you pay the 13.8% or now 15 on the amount above it. So they're reducing that. So that means that £4,000 difference is now going to be subject to that 15% hike that they've put in. So what's 15% of £4,000? 10% is 400, so £600 more. £600 more per employee.
Yeah.
Again, for the small business, to be fair, that does make a difference for small business. But imagine £600 times 1,000 employees. That's
crazy,
lot of money.
right?
Yeah.
That's
so for the
lot.
companies that have thousands of employees, hundreds of employees, they're the ones that are really going to feel it.
Yeah. So it's kind of maybe safe to say we haven't, because some of these changes, like I said, the NI one is coming from 6th of April, 2025. The impact of it could still take some time. In a way.
And no.
Unless you think that they've already planned for it.
Yeah, so they would have planned. So like, especially big companies. Big companies have to people plan, that are like tax advisors, like a whole team. Their whole responsibility is to plan for the next year, right? And so people would have already began to factor in these changes into next year. So in some places, this is a period where they're telling you how much your pay increases for the next year, all of that kind of stuff. And so they've already done their planning. And the fact that these announcements came out last October means that they would know that these are coming, and so they would have already made their decisions. They're not going to wait till April.
Yeah. So I think for people, it's very important to just like, of course, if your pay rise was not great, then you kind of know what the reason potentially was. And because you have an understanding of this, potentially, if it's something that where you need to move, we need to make changes, you have an understanding of this.
It's important to say as well, to just balance the table, right? Salaries extremely important and has much more weight, but you should also consider other things, right? Because if you move to another job that does pay you more, but now you have no work-life balance or whatever, you need to think about that as well. So see if there's other things that you can negotiate.
Yeah.
And in terms of obviously your lifestyle, if your job is giving you things that in
Work
other
from home,
ways,
for example. Yeah.
So for example, with the cost of travel, if your company is allowing you to work from home more than another company, don't just say, oh, the salary's higher there.
Exactly.
If the salary's higher there, now you have to go into the office 5 days a week. That's going to be more expensive for you. So you need to actually do the numbers.
Yeah, that's the thing. Is mad. So in the October 2024 budget as well, the government announced plans to increase the employment allowance from 5,000 to 10,500 and remove the 100,000 threshold. So making it available to all eligible employers from 6th of April 2025. Can you kind of break this down for us and what it will mean for, these businesses?
The what we just talked about in terms of businesses having to pay 15%, for example, on NI, and then also having to pay it from 5k salary and above. So we've just talked about 2 increases, but what they've said is that they will give you almost like a discount. So let's say you do all your calculations and you find out, right, company A needs to pay HMRC £25,000 now in all of these NI taxes. What they're saying is that they will give you a £10,500 discount. So that's just one lump sum. It's not per employee. It's just one lump sum off your whole bill. But these guys are not stupid. They've done the maths, right? They've increased on both sides. That 10,500 is not going to eradicate the fact that your bill is going to go up. It is an incentive. It's like when they say to you, buy 2, get 1 free, right? You forget that you were only going to buy 1.
Yeah.
So for you to buy the 2, you've actually spent more.
Yeah. Exactly.
Although you got, do you understand?
Yeah,
so although you got 1 free, but then what does that tell you about the actual cost price of the item? Because you know that they're not selling it at a loss.
Yeah.
So yeah, it's just a bit of mind games. But one thing to say on that is that that's, again, it's only eligible for businesses that have employees that are not just the director. So if you're just like a single person, doing a contract via your limited company on a day rate or something, that doesn't apply to you. You don't get that employer's allowance.
Yeah. So actually, on that topic, for contractors, how do all these kind of changes, like the NI, the employment allowance, how does that kind of impact contractors?
So definitely the NI as a business. So if you're paying yourself a salary above the allowance, so now from the 5k rather than the 9,100. So from 5k, you're going to have to pay 15%. And then also you're not going to get that grant, that 10,500.
Wow. Yeah. Okay. So for contractors, it's going to become even more expensive.
Exactly. And that's one thing that I've seen consistently in the last 8 to 10 years is really trying to rough up the contractors.
I remember when contracting was lucrative, it was nice. They don't want it. They don't want that.
That was the way to how to become a millionaire, become a contractor.
Gosh.
They've torn that area into shreds. They've just literally gone, no, we don't want you to have no fun over there. Be an employee or be a business owner, because they can control it more. But that contractor space is almost like your best of both worlds. I think you can still make it work. There are still some contracts out there. There are still people making money in that space. It's just not as bustling and hustling and bustling as it used to be. You've got to work hard to get your contract.
So with NI, right, how can contractors kind of make sure that they kind of reduce any kind of NI liabilities as much as possible?
So one thing we always recommend as an accountant to our customers who are contractors is that you pay yourself. So before we used to recommend that you pay yourself 9,100 so that you can still contribute to your NI in terms of for pension, but it's below the threshold so that you didn't have to pay employers NI. Now that number's gone down to 5,000, it means that anything you pay yourself over above 5,000, you're going to end up having to pay employers NI, right, on it. However, I would recommend that you still have that minimum salary. I believe it's about 6,000, 7,000, so that you are making enough contributions into your pension pot, basically, for you to be eligible for pension.
Yeah,
because you are working, right? Yeah, for state pension.
Yeah.
You don't want to have worked all these years and then not be eligible for state pension
Exactly.
just because of £10 or £50 or £100, whatever it is. So yeah, it is going to make it more expensive. The number that I believe I will now be recommending that people pay themselves as a salary is going to be in line with the minimum for the NI contribution, so that you can get benefits, not just state pension, but actually, you know, even like job seekers, heaven forbid, if something happened, other benefits, maternity pay, all of that. Yeah, SSP if you're sick and stuff like that. You have to contribute to the system to be able to get money out, as I always say. And then what that means is that you're going to have to take out more as dividends.
Yeah.
But I don't think that's a problem because dividends has a lower tax rate anyway.
Yeah. So obviously, when we spoke in our previous episode, it sounded like, of course, like in terms of the UK, it made sense, like to be a business owner, there was like benefits. With all these kind of changes, do you think that the pendulum is swung a little bit more in favor to like the employee versus business in terms of the UK tax system?
I think they're definitely trying to cut even more into the limited company owners, especially the contractor type limited company owners. However, I don't ever think that just being an employee is good enough. Like, because again, tomorrow they can turn around and be like, oh, sorry, the tax rate is no longer 20%, it's now 25%. What are you going to do? Just the same way they're doing it to business owners.
True.
And then remember, we've been talking about this 12,570 that has refused to move for the last couple of years. It's not what it should be. So employees still have a lot of negative aspects from the tax point of view. For me, I think the ultimate is having a bit of both. And that just comes down to being someone who wants to build wealth anyway. Anyone who relies entirely on one income stream is always going to be, you know, at the risk of that one income stream.
Yeah.
But if you have multiple and you're investing here, you're saving there, you're doing a bit of different things, you've got different cash flows, you know, that's the only way to really defend yourself from the different changes.
Okay, so try to be on both. And to be fair, I do like the both, because you've described somebody who's doing both effectively, and I think that is smart. I think that you can get obviously the recurring salary.
Yeah.
You can do your business on the side and then take advantage of those lower taxes. You know, I guess sometimes when you're all in on business, the income's not always stable. It's very hard to have
all in on business is very hard.
Yeah.
It's very hard. It can be done, but it has its own challenges as well.
Yeah. So, okay. So I want to ask you subscriber questions because I've got two, I promise people that I would ask you. So one question was from Chisholm Singh 6142. In line with the current budget, would it be more tax efficient for an agency worker, e.g. agency nurse or social worker who works full-time for a recruitment company and gets paid over £30 hourly to set up as a limited company or sole trader?
So I can't speak to the £30 per hour because obviously it's going to now depend on how many hours you do. But what I'll speak to is the person in that situation. If your total income now is below 50,270, then I would say you should stick to being a sole trader. Even if it's 51, 52, 53, probably still stick to just doing being a sole trader. Reason being, it's cheaper to just do one annual self-assessment. It's simpler, it's easier. Bob's your uncle, as they say. But when you open up a limited company, there are other costs associated with it. The accounting fee is higher. You have to also report to Companies House, not just HMRC. There's a lot more admin. It can get a bit complicated. And so if you're going to go down the limited company route, it has to make sense. Therefore, you need to be saving as much as you're spending, if that makes sense. So I would normally recommend limited company for people who have income total annually above 51, 52, 53K. Then you want to be going and thinking about limited company. Okay.
Thank you. Hope that helps to the person that asked that question. And then the other one was Innate Sakova 9351. Their question is, if I take dividends up to 50K, I'll pay 8% tax, but my business will pay 19% tax on its profit. Together, it is 27%. How can it be better than 20% tax? The way is to find a perfect accountant who will reduce the profit of a company as much as it's possible. But then if a company has a small profit, how will I be able to take dividends?
Exactly. You can't have the best of both worlds. So first of all, what I would say is that if you're read the beginning of the question again, because there was a bit of
Yeah.
the stuff at the end.
Kind of confused. Yeah, sorry.
Just read
It was the way it
beginning
was
part.
written. It says, my question is, if I take dividends up to 50K,
Yeah,
up to 50K,
that's what
I
it
will
is.
pay 8% tax.
Yeah.
But my business will pay 19% tax on its profit.
Yeah.
Together, it is 27%.
27%.
I think they were supposed to say, how can that be better? How can
Yeah.
it be better than 20% tax?
Exactly.
I guess maybe they're just talking about employee.
So
person, yeah.
two things I would say. Number one, just like the answer I just gave, if your total income is less than 50K, you don't really need a business. I'll be honest with you. You're in the same position. Just use self-assessment, right? Number two, however, the way that you are also benefiting is the fact that as a dividend, someone who's taking out dividends rather than a salary, ideally all your business expenses, your travel, if you need to go on business trips, your printer, your office chair, all of those things that you need for your business, materials are all being paid for by the business. If you are just an employee, you don't get that benefit. Basically, your money is taxed at source, and then you pay for everything else afterwards. So it's the other way around. So having a business, whether as a limited company or even as a sole trader, just allows you to get rid of those expenses first, which employees don't get to do, and then you're paying your tax on the bit that is for you personally. But one thing I will always say, and I've said it before, if your total income is less than 50,270, you don't really need a limited company. There may be reasons why you choose to have one, but those will be personal reasons. Generally, you don't necessarily need one.
Okay. Thank you. Thanks for answering those questions. So I've got a few more questions for you, right? So HMRC's phasing out its self-assessment portal. I guess what steps should individuals and business take to prepare for this change that's coming up?
Yeah, there's something called Making Tax Digital that they're trying to do. So it's not that they're completely getting rid of self-assessment though. It just means that I believe there's going to be an option for you to be able to link your bank account.
Ah, okay.
I feel uncomfortable about it.
No more tax dodging from dodgy people.
I
From
feel
the dodgy people.
uncomfortable about it. I won't
How many people are going to sign up to that?
What, they're going to make it compulsory? Yeah. Wow. Didn't you hear, as part of the budget in October, that they've hired, I can't remember the number, but a good couple hundred of people to help on tax evasion?
I mean, look, I don't tax evade, so I'm good. If you don't tax evade, you don't
You're
need to worry about this
but
stuff.
what I'm just trying to say is that they're investing.
Serious.
They're investing in that. So it's all part of it. To be fair, in the age that we live in, the HMRC system, I'll be the first person to, and I'm sure they will agree with me, is very ancient and archaic. It's very old school.
This is tech.
It could be
technology,
better.
yeah.
It could be way better. So yeah, it's necessary. But yeah.
Cool. So in terms of steps, what should people do to kind of prepare?
What people should do. Yeah. So you need to, and to be fair, I feel like people should be doing this already. You basically need to sign up for an online portal so that you can there's something whereby it's your HMRC services. Via your HMRC services, it gives you direct access to HMRC rather than having to do things on paper returns and stuff like that. And then you're going to be preparing yourself. So when you register on your portal, there's questions that they ask you, are you happy for this person to have access? Are you happy for that person to have access? So basically you're just setting up your profile. But one thing I would say as well is that you don't really need to worry about it now, because trust me, when the time comes and they need you to do it, you'll know about it.
Okay.
Don't stress yourself. They're still trying to get their ducks in a row, right? Yeah, because it was supposed to be done. It was actually supposed to be implemented by now.
Yeah.
But it's the deadline has been,
time.
it's been extended. So trust me, they're not ready.
Okay. So as we know, 6th of April is upon us. I guess what are the key actions that employees and employed individuals need to take before and after the 6th of April 2025
Yes.
to prepare for tax and other changes?
Yeah. So number one, you want to be maximizing that ISA allowance, making sure that if you're saving and investing, you're maximizing your £20,000 allowance. However, you may have previous ISAs from different years. You can still keep them running, but in total, all ISAs must not have more than £20,000. In terms of you putting money in, is different if obviously they've been invested and then now profits coming back in. So that's one thing, your savings allowance. And then of course your pension. So especially if you're a high rate taxpayer, especially if you've got a salary over 100K, you want to be putting as much of that salary that is above 100K into your pensions and getting ready to potentially do a tax return after. So you need to put the money into your pension pot before before the 6th of April, so you want to do it by the 5th of April, you could put it into, if you're a 9-to-5 employee, you could put it into your employer's workplace pension if they allow you to do that, or you can also set up your own, which is a self-invested pension, a SIP, and with that, actually, you have more control because you can choose where it's invested and all of that. You can choose your risk appetite, etc. And it's, again, another way of diversification. And so you're doing those two things before the deadline. As a deadline, I say the deadline, the new financial year, as that approaches, you want to be getting all your expenses, income, expenses, and all of that for the last 12 months. So that's from last year, April, till this year, April. And literally from the 6th of April, you can do a tax return from the first day if you want to get an accountant, or if you want to do it by yourself. Because the tax year has finished. So you're in a position to do that. So you want to be getting your giving receipts, anything, your statements from where you've made pensions, your business expenses, self-employed expenses, all of that kind of stuff that is eligible to be taken off your income, and then getting your self-assessment done from the 6th of April. Yeah,
and obviously people will also be thinking tax refunds, making sure your codes and stuff like that.
Exactly. So if you, I don't want to say this because I don't want everyone to go and mass do this, but if you need to do a self-assessment, then you do need to register. And so you need to register online. So you can register from now. You can register. The only thing is there's no need to register from now, but you can register to get your UTR number. You need a UTR number to actually be able to do a self-assessment, to submit one anyway.
And this is the time probably as well. I think we spoke about this last year. This is when you should be getting your new tax code. You probably would have got it by now.
If you have, if there is need for one, so everybody
they don't change it anymore. Like,
so they do send a letter. They do
normally
send a letter. To be fair, this is the time that they do send the letters. However, in terms of most times, it should be the same. If you've paid the right amount of tax, then it should be same. The time it changes is when maybe you've paid less tax, and so they need to take more in the next year. Or maybe if you paid too much, then you might be due a refund. But most times, if everything's all okay, it should be the same. Amazing. Okay, so my final question to you is, and of course I have to ask this, what are your top tips for minimizing taxes in the 25 to 26 tax year? 25 to 26 tax year. It would, if I'm honest, it would 2025, should I say? 2025 to 2026 year. I would say begin to invest outside of the UK. I'm sorry. So that's your top tip for minimizing tax? Wow. Yeah. What's number two? And that's if you've already, okay, let me give a caveat. If you've already imagine you've already maxed out your ISA. You've already got 1 or 2 buy-to-let properties. You're already like maxed out. You're already a high rate taxpayer. There's literally almost no room to move. But if you haven't done those things, then number one, your cash, your ISA, stocks and shares, if you're young, so stocks and shares. I do believe in the stock market, but it's not something that I actively push because I know that sometimes people don't really understand it. They can make mistakes. It's for the long run. It's not always, it can be a bit more risky. So I'm not one to actively push it. I'm sure you've got experts that have come on here to talk about, all of that. Exactly. So people can listen to them. But basically, in terms of like saving your stocks and shares or your cash ISAs, basically your ISAs, any ISA account, you're investing into pensions, if possible, and also using a limited company for your extra income if you're a high rate taxpayer. And then, like I said, if you're already a high rate taxpayer, you've got property, you've maxed out all your other allowances, start to look outside. We're gonna have to bring you out for another episode. It's not. It's not. Right. Yeah, you're right. It's not. We should start thinking more broadly. That's the truth. We're not, we can do more. Island. Exactly. No, thank you so much, Benedicta. This has been such a great episode. It's been great to catch up with you on, all things tax. And, you provide so much value again, just like we did in the previous episode. Where can people find you, of course, if they want to reach out to you? So I normally hang out on Instagram, but also available on TikTok. And the account or the @ is Beniratio Finances. So that's BENIRATIO Finances. And then if you want to look at my website, it's beniratiofinances.com. So www.beniratiofinances.com. And you can reach out to me there. We got a new website. Amazing. So you can check out. I'm looking forward to seeing One thing, can I plug myself? Yeah, of course. Go for it. Last year, you asked me, what can you expect to see from Benedicta in 2024? Yes. And one of the things I said was, I'm going to be doing a lot more courses and education. Okay. I launched 4 courses last year.
Really?
Yeah.
Wow.
One, how
That's
to do your
amazing.
self-assessment by yourself.
Yeah.
One on money foundations in terms
Wow.
of like credit, property, all of that kind of stuff. One for business owners to understand business and how to get tax back, like the stunt that my customer pulled.
Yeah.
And the one that I'm the most proud of was I launched a course called Your Dream Accountancy Practice, where I teach accountants
amazing.
how to open up their own accountancy
Wow,
practice.
well done.
And now I have my own little prodigies who
Wow.
are like killing it on social media.
That's
Every time I see them, I'm
crazy.
so excited.
Wow, well done. Congratulations on
Thank
that. Like,
you.
look how much you've done in a year. I'm so proud of you. Like, it's such a full circle moment because, like, you know, that episode did so well, but you also did things and you did more, you provided more value. So yeah, and I'm really, really happy for you, like, and
Thank
the
you.
things that are doing. And again, like, I hope that in this episode, people that I hope that you found a lot of value in this. Do you have any final words for watchers and listeners?
Don't be passive, be active. The fact that you're listening to this podcast shows that you're already an active person anyway. You're trying to get information, you're trying to be knowledgeable, but once you've got the information, take action. Yeah, don't let things happen to you, you happen to them.
Thank you so much, Benedicta. Thanks so much for having you on the podcast again. It's been great conversation.
you.
Thank you, and we'll do part 4 in the future. Definitely.
Can't wait. It's
Crazy.
always good.
It's amazing.
Thank
Thanks so much
you.
for tuning in to this episode of the podcast, and we'll see you next week's episode.